Hello, Avila Finance students. Welcome to week one. I'm Joe Barnhill, being your instructor over the next 2 months. So I want to welcome you to the course. Just want to remind you that I will be posting these every Sunday for the most part, sometimes on a Saturday if I can get it in early. But it's kind of an overview of the week for you. We do have a small cohort here right now. Last my count was like at 5 students, and that's totally fine. But I'm going to enjoy working with you over the next 2 months. And just kind of give you an overview of the course and how it works. I definitely encourage you to look at modules. That will kind of break it down by week what we're doing. I have put a key out there for the homework. So how I view homework is you need to show me the level of effort, how you come to the answers. So the answers are there, but I want you to demonstrate to me through paper or Excel or however you want to do it. You can upload files and PDFs in Excel. I encourage you to get used to Excel because we're going to use that later in the course. But if you have any questions, do ask questions. I'll try to check the course every other day with a small cohort like this. Plus, I'm going to school right now myself, so I feel for you all, but I will try to stay on top of that. You'll notice too that the forum discussions are in there, so these tie to current events, tie to what you're reading about in the chapter. There's a lot of great stuff from this past week because the stock market did not do well, a lot of correction, and also because interest rates are rising, that has impacted bond prices too. So the bond market hasn't done well, and the stock market's not done well, so we've got a little bit of correction. So in addition to your readings, like this week we have chapters 1 and 2, but you also have PowerPoint slides if you wish to view as a supplement. So let me talk a little bit about this week coming up. Some of the topics we're going to look at. If you think about chapter 1, it talked about the 5 principles of finance, as the authors pointed out from their perspective. One, that cash is king. That's the most important. Cash flow matters, and that's important for businesses to stay solvent. And you think about some of the issues GE is having right now with cash flow. They're having to sell off some of their businesses just to keep things going. And once an iconic company that was moved from the Dow is now having trouble with cash flow. They also mentioned that money has a time value, so that's going to become very critical later in the course as we look at things like net present value and total rate of return, profitability index. So when we make decisions, we have to include in those opportunity cost. Risk requires some reward. So if I'm going to be taking on more risk, I'm going to require greater reward. It doesn't mean that I'm going to get that reward, but I'm going to assess projects based on the risk that I'm taking on. Fourth item, they mentioned market prices are generally accurate. And if you kind of subscribed this week, as new information came in about rising interest rates, the market adjusted. So we're making an assumption of what we call efficient market hypothesis that was started by Eugene Fama, a Nobel Prize-winning economist, that the idea that we have always these variables going on in markets, but the market will always adjust to that information. And lastly, talk about conflicts of interest, kind of the idea of the principal agent theory. So they point out back to the 2008 financial crisis, the meltdown. Perhaps there wasn't enough regulation in the markets there, that certain people were not working in the best interest of individual investors. But in general, as principal holders, shareholders, or stockholders, we hire agents to manage companies. We try to give them incentives to do the best to maximize the wealth of that company. All right, just last thing, just to kind of mention some of that chapter 1, the forms of businesses. So that may be a review for some of you. From a finance perspective, we like to think of like underneath the CEO, there's a chief financial officer, and that chief financial officer breaks down into 2 areas. One, I would say, is the accounting with the reporting and the auditing, and the other one is the treasury. And that's what I worked in many years ago when I was at Sprint. I was a treasury manager. So I was kind of working on making sure we had enough money, managing the money, and looking at long-term requirements of capital, whether it was through issuing new stocks or issuing new bonds. All right, last thing in chapter 2, talk a little bit more about the capital markets. The IPO is the initial offerings, or that as a security is issued to a market, it may not go through an IPO, it may go through a direct placement. But a lot of times it's the Wall Street firms, this is how they make a lot of the money, is issuing new stocks and bonds. And actually bonds are one of the most prevalent uses of new sources of funds. It just isn't as sexy, it doesn't give as much attention. So, but also with that chapter, You're going to look about the idea of the idea of the primary market when it's first issued and the secondary. The secondary market is pretty much what you hear about in the news each night. It's the changing in those prices. So once a company issues a stock in an IPO, they only get the money one time, and then it's actually just actively traded in the market. Whoever wants to own that share is a piece of the company. And if you own that share, you have rights to capital gains if the price goes up and can sell at a higher price, or potentially like a dividend that you would receive from it. So last thing I just want to talk about the rates of return. The chapter talks about some historic rates, the idea that we have some stated rate, but within this rate there can be a real rate that adjusts for inflation. But there's also the idea like a nominal rate, which I think nominal rate is the actual stated rate. If you buy a CD and it says 4%, that's the nominal rate. But we assume that there's some real rate that adjusts for inflation, but there's also other premiums that are tied into that too. That might be tied into liquidity, it might be tied to maturity, it might be tied to risk. So you read about that. And last night I put out there on the website our course, the dynamic yield curve, because the authors explain some of the reasons why the yield curve may be shaped the way it is. One is just expectations about changes in the interest rates in the future. Another one is liquidity theory that says, hey, if I'm going to lend my money out for a longer period of time, I'm going to be rewarded for that. The idea would be like if I buy a CD for 1 year versus a CD for 5 years, would you expect the CD for a 5-year to give you a higher rate of return? And the last is the market segmentation, that there are individuals that want to borrow and sell short-term money, and individuals that want to borrow and sell long-term money. So that can have differences in markets due to supply and demand that can impact how much somebody is willing to pay for the price of money. Think of the interest rate as the price for money. So that pretty much wraps up this week. Do jump in as early as you can. Notice that the first forum discussion post is Wednesday, so look at the rubric and the requirements. You need to follow up to one more peer by Friday. I know we have a small cohort, but then also make another post to another peer by Sunday, and I'll try to jump in and make comments throughout the week. So it's especially important for you to jump in by Wednesday, because that tells me that you're enrolled in the course, and I can count you here as present for the first week. So other than that, have a great week, and I will talk to you online.